Well, thank you for having me, and thank you for having this hearing. I think it's very important that the public realizes the possible role the Federal Reserve has been playing in high oil prices. Unfortunately, a lot of my prepared remarks are going to overlap with what Mr. Reinhardt said, so I wish I had gone first, and then he'd be copying me. But I'll go ahead and maybe I'll say his same points in somewhat different language. So of course, what everyone knows is that the Federal Reserve has expanded its balance sheet since the crisis set in by about $1.6 trillion in terms of what's called the monetary base. So that's how much physical currency is in circulation plus banks' checking account deposits with the Fed, as it were. So to put that number in perspective, from the time the Fed was founded in late 1913 up until the fall of 2008, they hadn't put that much in. So the Fed has added more in the last 2.5 years than the entire history of the Fed up until that point.
And that number was 1.6 trillion, you said?
Right, about 1.6 trillion, and yeah, how much they've added since September of 2008 to the monetary base. And up until that point was 932 billion from 1913 to then. So when we say that there's unprecedented interventions, I mean, that's not hyperbole, it really is. And of course, we know same time period, the price of oil has, depending on when you start and stop it, has almost tripled. So the question is, do the two have anything to do with each other? Is the coincidence? So in my written testimony, I gave the two main mechanisms by which Fed policy could be driving the increase in oil prices. So the first one is what the Joint Economic Committee focused on in their recent report. And what they looked at was just the fall in the dollar against other currencies, because as Mr. Reinhardt said, oil is an international fungible commodity, so oil prices basically have to be the same for everybody once you adjust for currency exchange rates. And so if the dollar's falling against other currencies, that means the oil price quoted in U.S. dollars is going to go up, everything else equal. So in other words, Americans have seen oil prices go up more than the Japanese, for example. Right. All right, so that was... So if you look, they looked at, the JEC report looked at from, I guess, when QE1 was announced in November of 2008 up until whenever this report came out, and they said the dollar fell about 14%, looking at the index they used. And so on those calculations, that's how they're coming up with the figure that if the dollar had stayed as strong as it was when QE1 was announced up until today, then right now gas prices at the pump would be about 57 cents lower. Okay, so that's the logic they're using to come up with that estimate. Is they're saying the dollar has fallen since the announcement of QE1 and then QE2, and hence if the dollar stayed the same, then gas would be 57 cents cheaper at the pump right now. That's what their argument is. But there's a whole other possible mechanism that they didn't address, and that is it possible that the broad rise in commodities in general, regardless of the currency that you're using, could that also be influenced by Fed policy? And I would argue that it is, but it's hard to come up with a quantitative amount. Just for qualitative arguments, commodities in general have gone up. So it's not just that oil went up, it's commodities across the board. And even, like, for example, gold and silver, since the crisis and fall of 2008 till now, gold's gone up about 80% and silver something like 210%. Right? So I think it's very plausible to say at least some of that is due to people are afraid of the dollar being debased, and so they're rushing into the precious metals, you know, as an inflation hedge. It's not just that people in China are given more jewelry as presents, and that's why gold and silver are up so much, right? So if you buy the logic there when it comes to gold and silver, it's not a stretch to say, well, maybe some investors, you know, there's lots of liquidity floating around. What are they going to do with their money? They're not going to put it in real estate, obviously. Maybe they don't want to put it in the stock market because the economy's bad. Maybe they're going to go into commodities thinking, you know, this is surely wheat and oil are always going to have, you know, a demand, and so that's a way to protect my wealth in case there's future inflation. So that's the other possible mechanism by which Fed policy could be worked. So, you know, given whatever the world price of oil is, that the dollar falls, that's one thing, but the other mechanism is maybe commodities, part of that huge upswing is people are trying to hedge themselves against inflation. So those would be the two.
And if I can interrupt just for a second, and would you say, so that's just maybe just good, smart, practical investing versus any type of speculator driving the price up?
Well, yeah, I mean, it depends what your perspective is. To me, that's like saying, you know, it's cold out because the thermometer is showing a low reading. I mean, if people think that something bad is going to happen, then they react, and that's the whole point of, or one of the points of having futures markets in the first place, is to anticipate future movements.
earlier, you said, I believe, added to the monetary base 1.6 trillion since September of '08 to today, from 1913 to 2008, 932 billion. So in 3 short years, or less than 3 years, more than we did in, I didn't do the math, but what's that, almost 80-some years, or 80-some years. Mr. Baker, I think, called that timid in his opening statement, that the Federal Reserve's approach to this was timid. I assume you disagree with that.
Yeah, right, I disagree strongly, and I mean, partly it's a difference in our perspective as to what the appropriate policy response is. That if I believe that the problem was that Chairman Alan Greenspan had interest rates too low after the dot-com crash, and that helped fuel the housing bubble, and so that was the wrong thing to do. That caused malinvestments, and so to me, what Chairman Bernanke has done is just doubled down on the wrong policies that Chairman Greenspan put into place.
Yeah.
But I think Dr. Baker's coming from a different perspective, obviously, and so, right, so they would say it's timid because, look, it didn't work fully, so we need to put more medicine in, whereas I'm saying, no, that's poison, just pumping in, extra money that you're creating out of thin air, to use a colloquialism.
Do me this, maybe you and Mr. Reinhardt in a second. Rank order, I mean, look, because we got supply and demand concerns, we got turmoil in the Middle East, we got those who say speculators, and then we got the Fed and quantitative easing and the devaluing of the dollar. So rank order, and let's just, for the starters, say all have some influence on the price of fuel and ultimately the price of gasoline. So, but rank order them in which one has the biggest, which is second, which is third, and which is fourth. And I would also, well, I'll get to that article in a second, but do that first, then we'll go to Mr. Reinhardt. Dr. Murphy.
Sure. I mean, I think we should just be humble and say nobody knows for sure. We would have to turn back time and do the alternate universe to see what actually happens, right? So this is all speculative, no pun intended. I personally think that the Fed has not fixed the problem. Okay, so it's true, as Dr. Baker was saying, you could argue, well, no, the Fed averted a catastrophe, and so therefore, even though we're in a sense both agreeing the Fed caused oil prices to go up, but he's saying that's arguably a good thing in one perspective. But I don't think we're out of the woods yet. I think years from now we're still going to look back and say, when is the economy going to get better? So in that sense, I think the Fed is. I personally would say it's the Fed. Now, in terms of speculators, again, that's sort of a loaded term, but I mean, if people are worried that the dollar is going to depreciate strongly,
right. Our first question, too.
Yeah,
right.
that's what they're supposed to do. Like, literally,
normal
the
behavior.
Function is a futures market is supposed to
get it,
allow that.
So you would say the Fed's actions are the #1 reason that the price of gasoline for families and business owners went up, more so than turmoil in the Middle East, more so than rising demand from countries and rising demand period, more so than supply and demand concerns.
From the fall of 2008 till now, yes. I think if you're saying like the last 6 months, the Middle East, I think, is far a bigger influence of what's going on.
But over the last 3 years.
Right, if I had to pick one.
Dr. Murphy, would you say the record is not good and over the long haul here, or what would you say?
Well, right. I mean, the Fed was created to get rid of wild ups and downs, and then after they formed it, there was a Great Depression. So, I mean, the Fed's not had a great track record over its history. As far as your broader question, and I'm speaking on my own. This isn't an IER position on monetary policy, obviously, but I don't think the issue is, well, should it be Ben Bernanke right now making Fed policy or Treasury Secretary Geithner? I think if you're going to,
No, I mean, there was some question about the structures here, of whether or not there's public accountability, responsibility. If you can print, you can use print an unlimited amount of money, and basically, and until recently, in a non-transparent way, give it to banks who are too big to fail. They can park their money, gain interest on it, and at the same time, you got to have businesses starving for cash in my area. There are some public policy questions. Go ahead.
Well, right. My point was a lot of people, and I would subscribe to this view, say that there should be no such entity that can just create $1 trillion out of thin air and hand it to rich people. That you don't need to say, well, who should run this organization? There wasn't always a Fed, so if you're going to start questioning it, just go the full way.
Arguments. Dr. Murphy, your comments on Mr. McKinnon's piece.
I actually haven't read that particular piece yet, but yeah, I mean, I've been for a while very concerned about stagflation, that what the policies, both the Federal Reserve and federal government policies the last few years, that would slow real economic growth and also add inflationary fuel. If I could just, one thing I should have said before about the speculators, if I could just say one thing very briefly, is I just want to remind people that it can go both ways. That, for example, when President Bush back in, I think it was July of '08, announced that he was going to end the executive branch's moratorium on offshore drilling, apparently oil prices dropped $9 during the speech itself. Okay,
Yeah.
so that's what I mean, that when people think that there are future events that are going to affect the supply of oil, like that can drive prices. And that's,
Yeah, and if the Congress of the United States would pass legislation saying we're going to expand dramatically drilling and exploration and get the resources that are out there, most likely that would have an impact on the price of oil. Not in the 8 to 10 years that people say it takes to get the product to market, but when it's actually done, when the bill's passed.
right, because in the way that happens, it's not that there's a time machine. It's that, so if U.S. policymakers expedite and give the green light, so people think that U.S. production is going to be higher in the future,
Sends a message.
then, you're right, then current producers with excess capacity, like Saudi Arabia, they increase current output. So that
Just like if we would actually cut spending and cap spending and send a message to the market, that might actually help maybe PIMCO get back in the Treasury market and Standard & Poor's change their outlook, right?
right. So yeah,
It sends a message. I mean, it's of critical importance. Thank you, Dr. Murphy. Mr. Baker.